Hello everybody, this is Carter Froelich with the Property Ledger, and today's tutorial will be inputting a single family home into the Property Ledger. To begin, you would go to the propertyledger.com, input your user information, your password, and you would come to the dashboard. The dashboard is really the nerve center of the Property Ledger. It shows what the net worth of your portfolio will be upon the payoff of your last mortgage. It also shows you what your net monthly cash flow will be in relation to your portfolio once that last mortgage is paid off. So for those of you who are using real estate as your retirement plan, this information obviously is going to be very important for you. Here's my net worth. Here's what I'm going to be able to use on a monthly basis in my retirement. For today, let's assume we're analyzing a new rental property for acquisition. So we would click on the Analyze New Rental Property, and we're taken to the input screen. The Property Ledger has 7 input screens and 7 steps, which are shown along the heading of the page, so you always know roughly where you're at. The first is just getting in the property information. So let's assume we're looking at purchasing a single-family home. Let's call it 123 Elm. It is a single-family home. The other thing I'd like to point out is you can see all the different uses that the Property Ledger will accommodate, but for our purposes here today, we're looking at a single-family home. Obviously, it has 1 unit, and let's assume it's 1,400 square feet. If we had already purchased our unit, or we were sure we were going to close on the unit, we may want to click on this box, which will automatically upload it to our portfolio summary, which is a summary of all of our properties that we own. We go over to the address and put the address as 123 Elm Street. The town is any town. Let's assume we're in Minnesota. Obviously we're in the United States, and we type in a zip code. That's as simple as it gets. Click and go to our next input page, which are the property costs. Let's assume that we purchased this property on the 2nd of January 2012. The purchase price is $98,000. We also have, even though we're purchasing a property for $98,000, and in many instances the fair market value of the property may be greater than our purchase price. So let's assume in our instance here we're getting a deal, and that property is really currently worth $115,000. So we could input the $115,000. Now all of our appreciation will be based off of the fair market value of $115,000 as opposed to our purchase price. We also have the ability to, for tax purposes, track 5- and 7-year property. For our purposes here, we're assuming that we're not going to be having any of that, so we'll just leave those blank and go over to the percentage of our cost allocated to land. Now when you purchase a rental property, obviously you're purchasing sticks and bricks on land. The sticks and bricks are depreciable, but the land is not. So we need to indicate what percentage of our purchase price is non-depreciable, and generally it's about 20% is kind of a rule of thumb. So let's put in 20%. Now over time our property is going to appreciate, and we want to take that into account. And so the first input we have here is for the default annual appreciation rate. Let's assume that on average it will increase at 3% per year. We also have the ability to input variable appreciation rates. So say for instance, even though our default appreciation rate is 3%, for 2012, 2013, in 2014, we don't think we're going to be achieving that 3% appreciation rate. So we want to input something else for those years, and I'm going to show you how to do that in just a minute. The net present value discount rate is the rate that we utilize to determine our net present value, and it's also the minimum rate of return which we as investors are willing to accept on our property. So let's assume that our minimum rate that we're willing to accept for purchasing real estate in today's market is 15%. In the future, we're going to be selling this property, or at least for our calculations, we need to take this into account. So let's assume 7% future selling expenses. And our sale date, we could input this if we were doing a buy and flip. But for our purposes, we're going to buy and hold it, so we're not going to input anything there. On the bottom, now you can see we can save our information and enter variable appreciation rates. We can save and add closing costs, or we could save and continue to the future improvements. Well, we had indicated that we want to put some variable appreciation rates in, so let's click on that and move to that screen. For 2012, the year in which we're purchasing the property, we're assuming that we're not going to have any appreciation whatsoever. So let's input the year, we input the rate, and we want to go to 2013 next. So in 2013, we're assuming a 1% appreciation rate, and for 2014, we're assuming that we will get a 2%. So once we've input our variable appreciation rates, we can go and add closing costs, or add future improvements, or just skip and go directly to future improvements. But obviously we want to save our information. Click on Next. You can see here we're now on the third step, which is future improvements. We are going to replace the appliances, and that's at a cost of $1,200. We're making those improvements the day after we close on the 3rd, and adding the new appliances will increase our fair market value, but let's assume by only 50% of our costs. So in this case it would be $600. We can add other improvements at the bottom. We can save and continue to financing, or just skip to financing if we don't want to save our changes, but obviously we want to save them and move to our financing. Within our financing section, I'd like to point out that we can start by inputting a single mortgage, or we can put a primary and secondary mortgage. Additionally, the property ledger allows you to go in and refinance multiple times during the analysis period. And our analysis period goes out 60 years, just to let you know. But today, let's go look at a single mortgage. So we can click up here and call our mortgage anything we want: Wells Fargo, B of A. Here we're just calling it mortgage number 1. We have our property purchase price plus our fair market value. We have the ability to either input a down payment amount or put in a percentage. Let's assume we're putting 15% down. These amounts will automatically recalculate for us. It's a fixed loan. Say no to variable rate interest rates. We have the ability to pay interest only should we so desire, but this will be a fully amortizing mortgage. The start date is on our close date. It is a 30-year mortgage, so we input 360 months. If we wanted to, we could make additional principal payments, but we're electing not to do that here. And let's assume that we have to pay the mortgage broker 2 points on the origination, and we want to add those loan costs to our loan balance. And that's as simple as it gets. Click on Next, and let's move to our income taxes. Now, one of the benefits of real estate investing are the tax benefits that real estate investors receive. And so it's important that we have an understanding of what those benefits are. So in this section, we're inputting our tax information. Let's put our marginal federal income tax rate of 35%. Now obviously these will vary depending upon your particular situation. Our capital gains rate, let's input is 15%. Our state income taxes, I'm assuming, is 8%. And then this is our depreciation period. As most users of the property ledger are purchasing residential property, the depreciation period for residential property is 27.5 years, so that's the automatic default. If this were a commercial property, you'd want to replace this with 39 years, as that is the IRS standard depreciation period for commercial. Additionally, we have to determine if we are active real estate investors. For our purposes, we are, meaning that we manage our properties and we're involved in the day-to-day activity. Therefore, we qualify as a qualified real estate investor. or qualified real estate professional is the IRS term. If we did not, we would have to click on this, and this would allow us to be treated as if we were not a qualified real estate professional, which would mean that we would lose some of our benefits for income tax purposes. But here we are assuming that we are a qualified professional. We are not selling our property, but if we did and we wanted to do a 1031 exchange, we would click on this. Now let's move into our rental income, shall we? The rental income portion of the property ledger allows you to input your rental income. It allows you to do that as a single entry, or you could add a rent roll. Now, for our purposes, because this is a single family home, we're only going to input the market rents of $1,200 a month. Our default vacancy rate, let's assume, is 5%, and our rental growth rate over time will be, let's say it's 1%. We have the ability to add other income, add a one-time income. Say, for instance, if there were just a one-time event where we would be generating income, we could click on that. We also have the ability to go in and add actual income, and we'll be meaning once the year is over, you can go back in and replace your operating expenses and your operating revenues with actual results, so that you can always be tracking your actuals, okay, up to a certain point, and then your pro forma would continue thereafter. And we're going to cover that on one of our tutorials. We also can save and then enter a rent roll if we wanted. But in our instance, we're going to save our operating income information and head to the operating expense categories. So we click on Next, and you'll see that we've come to step 7, the operating expenses, and we have the ability to add all of our operating expenses related to rental property. We tried to list as many as we could, and also put categories in here where you can add other categories that may not be included that relate to your specific situation. But beginning at the top, let's just click on accounting, and let's assume we're going to pay an accountant $250 to perform our LLC tax return. We go to advertising, and let's assume we're going to have, even though we're using Craigslist, we'll do some newspaper advertising for vacancies for $50. The thing I'd like to point out is you can see that now we have the amounts here. The percentage that the $250 represents of our rental revenue, as well as what percentage the $250 represents as percentage of total expenses. And as we only have 2 expenses in, you see that the accounting is currently 83%. These numbers will change over time. And then we have the expense on a per square foot basis. When the unit is vacant, we're going to have to pay somebody a couple $100 to come in and change or clean the units. We don't have a homeowner's fee. We have property or homeowners and liability insurance that we have to pay, and let's assume that's $690. We'll have maintenance of $400, and let's assume we have a management fee. And I really encourage you, even if you're doing your own property management, to put a fee in here. Let's assume $50 a month for a total of $600. When it comes time to sell that property, if you don't have a management fee in here, somebody will put one in. Repairs, let's assume we're covered with our maintenance. We get down here to our property taxes. Let's assume that's $1,200 a year. And let's assume the tenants pay for all of their utilities. However, we are paying for trash removal of $240 annually. So that would be our last expense. You can see here now that we have a listing of all of our expenses. As you see with the accounting, that the percentage of revenue is still 1.83%, but now as a percentage of expenses, it's decreased dramatically. We go to our bottom line and see in total we'll be paying $3,630 annually in operating expenses. So now we've got basically everything in here that we need to determine if this is going to meet with our investment goals. So we click on the property summary. The property summary is nothing more than just that. It summarizes all of our inputs and shows us what our financial returns will be. We have here all of our property information, the name, location, date purchased, purchase price, and the financial dashboard over here shows when that mortgage will be paid off, what the net equity will be at payoff. In this instance, the house will be worth $197,000. And on a monthly basis, this home will be generating $712 in net income to us that we can use to in our retirement. We can use it to buy other houses. We can use it to send the kids to school. We can take vacations, etc. So now we get down into the financial aspects of the property ledger. But one thing I'd like to point out is that we have the ability to download all of the various documents that we feel are important into the property ledger. And so in this instance, we could come in and we could download pictures. We could include our purchase agreements. We could have lease agreements. We could have management agreements. We could have move-in, move-out forms. Anything that we felt was important, we could upload into the property ledger and have this at our fingertips 24 hours a day, 7 days a week, 365 days a year. So I want to make sure that you're aware of this and that you use it, because it's a great feature, especially if you're traveling a lot. The financial analysis of the property ledger goes out 60 years. The first really gets into our rental operations, meaning a summary of our rental income, our vacancy and credit allowance, our operating expenses, showing our net operating income. This also gets in and shows our mortgage payments. You can see our capital improvement that we made that first year, and then our tax benefit or expenses. So at the end of the day, in the first year, we're going to be netting out $1,900. The property sales and appreciation schedule shows you what the value of the property is as it increases over time. It also shows you the improvements that we made are increasing in value. We net out our sales expenses, so our adjusted projected sales price would be here, and then we show our payoff of the mortgage and our income tax consequences as a result of the sale here to show our net cash flow from property sale. So if we were going to sell the property in 2012, here's what our net cash flow from the sales would be. If we were going to sell it in 2017, here's what we would be netting out in terms of additional cash from the sale. Then we get into various financial analyses. The first is the cash and equity position. So we show the cash that we had generated from operations, cash generated from the sale of the property, you can see here, less our original investment. So this shows our cumulative cash over time that would be accruing to us depending upon how long we held the property. And then we get into the financial metrics. We have the debt service coverage ratio, so you can see we're in excess of 1. So we're having positive cash flow, more than enough to make our debt service payments. Our loan to value, you see, goes down over time as the property appreciates. What our cap rate is based upon current operations, gross rent multipliers, the net present value at 15%. And as you can see here, we're returning more than 15%, because when we discount our cash flow back, you can see that these numbers are all greater than 0, which means that we're generating a rate of return in excess of 15%. And then you can see our return on equity numbers, our cash on cash return on investments, cash on cash return before taxes and after taxes, and then our internal rates of return. So there's a lot of information there that the property ledger generates. we can get in if we wanted to take a look at our tax report, and we could see, get a detailed breakdown of all of our applicable tax calculations here, not only from rental operations, but on the property sale as well. If, let's see, we go back to the property summary, and we wanted to create various reports, we have the ability to do that. We can create summary reports, we can create the tax analysis, we have the ability to create an amortization reports for our files related to the payoff of our mortgage, and then we have various graphs that we can show as well. And let's say we wanted to show the equity over time. We would click on that. And you can see here is the graph for equity over time, and obviously as this thing continues to move up over the years, you can see how the equity increases over time. So and you can see here where the flag is indicating B, that is where the mortgage is paid off, and you can see what the equity is at that point in time. So a lot of different things that you can do with the property ledger. We're really glad that you've taken the time to take a look at this tutorial, and we hope that this has been beneficial for you. Thank you very much.